And they also do a full financial audit, going back 5 years. So there's been precedent set in Pennsylvania that they've actually gone after the child, the son, that was working with the nursing home, with the father that was in the nursing home, and they won. And the son became liable for the father's bill at the nursing home.
So the nursing home people hire somebody to...
It's not the nursing home, it's actually the county. It's the Department of Aging that does that. Because they're the ones that are gonna have to pay the bill if you file for Medicaid. So, I know it seems like, well, how are they gonna know? If I give money to my kids, how are they gonna know? They're gonna know. And it's not the matter, it's about, you're now just disqualified. If anybody's an Animal House fan, right, where they push the girl back in I said they're gonna put you in a shopping cart and push you back to your kid's house and ring the doorbell and run. Because you're gonna be disqualified, they're not gonna take care of you because they're not gonna pay you.
How do they know, say, you know that you have a terminal disease, say, quit, I'm gonna take money out and go to the casino? How do they not know that I took 10 grand out every week to go to the casino and go low ball?
You would still be disqualified from if you couldn't justify the expenses, you would be disqualified. They would tell you your family needs to take care of you. I don't know of anybody that did that. I'm sure that whether or not it was deliberate or just unfortunate that those types what if it was stolen, right? What if somebody stole the money from you? They don't take care of you or something like that. They will, like if you gave it to your kids, like occasionally what I've had happen with clients in the past is, mom or dad is sick and we think it's going to get worse. They have enough assets to pay for 5 years, but then they gift the remaining assets to their kids. And we always tell them, you got to keep it in a cash, conservative bucket, and keep it on the side. Pretend that it's not there because it's really not yours until after the 60-month look back has passed.
And if they take money out of there, we did this for my mom, then you have to keep receipts to show that your parent or whoever
Right.
else took the money out.
And that's why it's so important to get an elder care attorney or an advocate involved out front, and you need to bounce all those things off of that person before you do it. Because what you don't want to have happen is you to be disqualified from the benefits that you would normally qualify for because you thought you could, hide the money somehow. The only way to do it is maybe just move to Ecuador, right, and expatriate to an expatriate. But I'm not so sure they would take care of it. But there is ways to protect the assets. So for a married couple, if you have the right language currently in your financial power of attorney that allows you to gift assets, you could probably have protected 80 to 90% of that spend down. If you had the right, if you're married and your spouse, the only spouse can do this. Because the law says you cannot impoverish a spouse. I've done this maybe 3 or 4 times in the last 3 to 5 years for clients, where we've probably been able, not because we were good at investing or we, are the best, but because we made sure that everything was in order for their total financial plan, which includes their estate plan. We were able to protect I think it's probably in the range of about $3 to $4 million that we were able to protect for those clients cumulatively. And that's pretty powerful. Like the gentleman I told you about, that his wife in there, for him probably protected about $600,000 of assets. I have another gentleman that we did it for 2 years ago, and his protection was probably about $800,000 to $900,000. So having the correct language to be able to protect the assets is very important, because you worked long and hard for that money. Now, nobody in here is a nursing home CFO, right? One time that was the case. Guy was a CFO. He believes in, he's actually told me, he said, look, I believe in that, protecting it for your spouse. I don't think you should spend all your assets because you don't know how long your spouse is going to live. But he said, when it comes to the next level, I don't think you should be protecting it for your kids. That was his personal opinion, because that's what he had to do for a living, is he had to go out and protect or get those assets from people. But the gentleman that in Pennsylvania that they set precedents with, anybody know one of my good friends he's Greek. They're all in the restaurant business. They own several restaurants. But the gentleman, I don't know this gentleman that I have to, he's a Greek, and if anybody knows it, has any Greek buddies, they go back to Greece like we go to Ocean City, Maryland. And they all have family there, so what happened was the dad was Greek in the nursing home. They were trying to do some funny business, trying to hide some assets, and what happened was the dad left, they kicked him out of the nursing home, and then they sent him back to Greece to live with family. And what happened was then they sued the son, because the son was the one that was communicating and dealing with the nursing home for the dad. And the court found him liable because he was the one making the decisions, or was part of making the decisions. So if you look it up, I think it was almost, you know, a couple $100,000 that they found him liable. Any other questions? So again, important to have a plan on how you're going to address the long-term care need. You know, what maybe, you know, if you can't perform activities of daily living, if you have a cognitive impairment, what are advantages of long-term care insurance? You want to make sure that if you're going to buy a traditional type of long-term care insurance that is tax qualified, which means the premiums may be tax deductible. There is pre-existing condition limitations. Underwriting is very tough nowadays. It's become way more stringent. The elimination period, the benefit period, indemnity benefits, inflation, it's all, you want it to be guaranteed renewable. You want it to provide home health care, because that is typically why people are buying it, because they want to stay at home. Assisted living, adult daycare, there may be some discounts. Don't count on those. They're going, you know, along. They do typically provide a lower a discount if both spouses are applying as well, and then you want to have a quality of an insurance company. So there's carriers out there that we would call like a premium carrier, and then there's ones that they're still good companies, but they're more in the high risk market, so they're going to be more expensive with benefits that aren't as good. And what's not in the book is called the hybrid plans. So, you know, one of the biggest complaints about traditional long-term care insurance is you pay a premium, and you pay, and if you never get sick, what happens? You pay the premium and you got nothing. How many of you pay your homeowner's insurance? Probably more likely that you're going to have a claim on long-term care than you will have a homeowner's claim. I've had 3 homeowners claims, so I'm the exception to the rule. But, you know, the hybrid policies are life insurance with a long-term care benefit. And there's 2 types of those. There's what's called like just a regular life insurance policy that you may have already, where you can add a rider that says that you can access a portion of the death benefit every month in order to pay for long-term care insurance. I'm not a huge fan of those, but sometimes they apply. And then there's the hybrid ones that have come out more recently in the last, I think, about 10 years, where they're really geared towards the long-term care part, but it's still a life insurance policy. So hypothetically, if you put $50,000 in, you have $50,000 in cash value, and you have a long-term care benefit, and if you die, the death benefit might be $60,000. So it's not, you're not burning the money. But they're definitely more expensive than the traditional types of long-term care insurance. In addition, traditional long-term care insurance is the only insurance out there that I'm aware of that's, when you sign, there's one specific disclosure that says, by the way, the language is a little different than what I'm going to put it here, but it says, we've designed these premiums to be level for the life of the policy, but we're probably going to raise the premiums at some point in time. And they have. One of the bigger carriers, I was meeting with a client about a little over a year ago, and there was a premium increase the year before. And we were going through some reviews, and he goes, hey Vince, by the way, I just want to ask you something real quick. They're not going to raise my premiums again this year, are they, on my long-term care insurance? And I said, no. And then I started going back, and I said, well, wait a second. I've never seen them raise rates to premiums 2 years in a row. So we go through the rest of the meeting. Sure enough, his premiums due in I think March, but in January they sent out a letter saying, by the way, your premiums are going to go up when you go to pay your premium, what do you want to do? Because they give you choices. You can either pay the increase, you can change your benefit to keep the premiums the same. But what had happened was our practice manager was working on our phone system and trying to get our, how the phones ring through, cycle through. And he was calling and he was trying to hit my extension, and he was hitting my extension, but he would get Colin and then he would get Dylan, and this is just the perfect timing when he was calling. Finally, he got my partner, Brian. He said, Brian, I'm trying to get hold of Vince. Told me my premiums weren't going to go up. They went up. Tell him to call him. So Brian thought he was all mad because I told him that his premiums were never going to go up, which I didn't say. He was just upset because he couldn't get through to me on the phone. But sure enough, what we looked at is we went and looked at his premiums and what he was going to pay. We were actually able to save him money on the policy because they had a great policy that they had bought 10 years ago. They had like a $10,000 or $11,000 a month benefit pay, and there was no reason for them to pay an increase in premiums because they both have pensions, they both have assets. It just didn't make sense for them to pay it. So even if you get those premium increases, it may not make sense for you to pay them, or may make sense for you to modify your contract in order to keep it. Their premium is going up, I think, $1,500 a year combined between the two of them. I said, well, that's it's a nice vacation, or at least a long weekend. So life insurance, I'm not going to spend a lot of time on this. Term insurance, annual renewable term, that's probably what you have through work. If you still have group coverage, premiums may go up every year, or they may be age banded. Level term is you pay a level premium for a level death benefit for a certain period of time. And then decreasing term, there's still some carriers out there that have that. Somebody might have tried to sell you mortgage insurance. Basically, sometimes you buy that to replace, to pay off debt. So it starts with a $300,000 mortgage, right? $300,000 in death benefit, and the death benefit goes down each year, but it's always enough to pay off the mortgage. Most